on this, what has clearly become a very the new ACA Information Reporting requirement. One purpose of that requirement is to enforce the employer shared responsibility provisions. So we'll do a brief review of what that includes, including how employers need to make full-time status determinations of their employees. Then we'll take a look at the new forms. We're not going to spend a lot of time on them, but we'll focus on just highlighting some of the more difficult aspects of completing the forms, which includes indicator codes 1 and 2. And then we'll finish by reviewing next steps and how you might go about completing this reporting requirement. There will likely be quite a few terms that I'm going to mention throughout this conversation. I just want to highlight a few of those for us. The first 3 bullets on this slide refer to 3 new sections of the Internal Revenue Code that were added by the Affordable Care Act, Section 6056, Section 6055, and Section 4980H. I'll talk about those in a little bit more detail in a few minutes here. Full-time, for purposes of reporting and shared responsibility, means working 30+ hours per week or 130 hours per month as determined under an IRS measurement method. The IRS has provided 2 methods that employers must use for determining full-time status. Minimum value means the plan covers at least 60% of the cost of services. And affordable means that the plan cost for self-only coverage under the lowest cost plan does not exceed 1 of 3 affordable safe harbors. Applicable large employer, or ALE, we'll be using that acronym a lot this morning. And ALE is one that employed at least 50 full-time employees, including equivalents, in the preceding calendar year. When making that size determination, control group rules apply. An ALE member refers to an employer that is part of a control group. And lastly, aggregated ALE group refers to a group of ALE members. So those are some of the more important terms that we will mention throughout this presentation. So moving on to what employer shared responsibility is, or 4980H, there are 2 penalties under shared responsibility. The A penalty, often referred to as the no offer penalty, and the B penalty, which is often referred to as the unaffordable or inadequate offer penalty. Under the A penalty, if an ALE doesn't offer coverage to its full-time employees and their child dependents, it faces a penalty of $166 per month times their total number of full-time employees, if at least one full-time employee receives a premium tax credit in the month or an exchange subsidy. In 2015, in order to meet the offer requirement, an ALE has to offer coverage to at least 70% of its full-time employees. That threshold increases to 95% in 2016 and thereafter. That's the A penalty. Under the B penalty, or the unaffordable and inadequate penalty, an ALE might offer coverage, but if the coverage is unaffordable, say to certain employees, or it doesn't provide minimum value, the latter of which is very rare, it faces a penalty of $250 a month times the number of full-time employees receiving a premium tax credit in that month, or an exchange subsidy. A couple important notes to mention in determining 4980H liability are, 1, ALEs who do not offer coverage may subtract the first 30 workers, although that is that threshold is 80 in 2015 when calculating their liability under 4980H. So first 80 workers in 2013 get eliminated prior to calculating total liability. If there is exposure under 4980H-B, the penalties under that section are capped at the employer's potential penalty tax under 4980H-A. There is some important transition relief that applies in 2015 only. Firstly, there is relief for employers that have between 50 and 99 full-time employees, including full-time equivalent employees. They are not subject to 4980H if they can meet certain transition relief criteria, but they are still required to report, to do information reporting. There's also transition relief related to employers that sponsor non-calendar year plans. And lastly, when determining penalties, each employer of a control group or each ALE member is assessed penalties separately.
Patty, can I just jump in for a second? I wanted to reiterate a couple of things that you just mentioned because we have gotten questions about these.
Sure.
One is the transition relief, the 50 to 99 full-time employee. Just so everybody understands, you're off the hook for penalties in 2015, but not on information reporting. So you're still required to do this reporting that we're going through. And then second is the last bullet about the ALE members. One of the questions was, if a company owns several distinct entities, do they complete forms for each separate entity, or can they complete forms for the entire group? And the answer is that for an employer within a control group, you're responsible for reporting individually only on your own full-time employees. But, and we'll talk about this when we go through the forms, you'll still need to list all the other entities / employers within the control groups. The rules do allow an option for one filing to be done on behalf of the entire control group, but ultimately each individual employer within that group is responsible to ensure that the reporting gets done. So I just wanted to kind of call that out on the whole control group situation, because that is a question that we have gotten. So.
Yes. Just to underscore that, each employer that's part of a control group needs to report information to the IRS on the full-time employees that work for that employer. So it needs to be separately distinguished by employer, by employer identification number. Okay, so that's a very brief overview of employer shared responsibility. Only a full-time employee can trigger a penalty. We're going to talk a little bit about what full-time means, because the IRS has provided two methods that ALEs must use for determining who's full-time and who's not for purposes of this reporting. Those two methods are the look-back measurement method and the monthly measurement method. Under the look-back measurement method, employees' full-time status for a future period, or what the IRS calls a stability period, is based on their hours of service in a prior period, or what's called a measurement period. In this example, the employer is using a 6-month measurement period. So they want to lock their full-time status or their eligibility, if they're using it for health plan eligibility, for the first 6 months of 2015. So in order to do that, they looked at their employees' hours, total hours of service, between May 15th, 2014 and November 14th of 2014. They calculated those hours, and anyone who averaged 30-plus hours is considered full-time for the first 6 months of 2015. And to put this in context of the IRS reporting, those employees must receive a 1095-C, and the IRS must also receive a copy. If, after looking at hours between May and November, employees averaged less than 30 hours, they're considered part-time for the first 6 months of 2015. And they wouldn't have to be issued a 1095-C statement unless they were offered coverage under a self-insured plan. We'll go into more details about who gets what form in just a minute. But that's the look-back measurement method versus the monthly measurement method. And under the monthly method, an employee's full-time status for the month is based on the hours that they worked in that month. So if they averaged 130 plus hours or 130 plus hours in the month of January 2015, for the month of January 2015, they're considered full-time and will be reflected accordingly on the 1095-C. If they average less than 30 plus or 130 hours, they would be considered part-time. So those are the two IRS measurement methods. Okay, so let's dig in a little bit in more detail on what the specific information reporting requirements are. There are two reporting requirements. Those are under Code Sections 6056 and 6055. Many employers will be subject to both requirements depending on the funding of their health plan. But let's look at each requirement separately. Under Code Section 6056, that reporting requirement is referred to as large employer health coverage reporting. So anyone with 50 plus full-time including equivalent employees is subject to 6056 reporting. That will require the employer to report the terms and conditions of the health plan coverage that they offered or didn't offer to their full-time employees. And the IRS will use this reporting to administer their employer shared responsibility provisions. The forms that the employer will use to meet that requirement are Forms 1094-C, which is an IRS transmittal or a cover form, and then the employee statement, which is Form 1095-C. So that's the 6056 requirement. The second requirement is under Code 6055. This is referred to as reporting of health coverage by health insurance insurers and sponsors of self-insured health plans. This requires all self-insured plan sponsors and health insurance carriers to report information on each individual that was provided health coverage. This will help the IRS to administer the individual shared responsibility provision. And the forms that are used for this purpose are Form 1094-C or B, which is the IRS transmittal, and as well as Form 1095-C or B, which is the employee statement. If you're thinking about not doing the reporting requirements, I would encourage you to reconsider. This is mandatory, and non-compliance carries significant penalties. Okay, so let's look specifically at who needs to issue what forms and by what time. And there's basically three scenarios. We have an ALE that sponsors a self-insured plan. That's one scenario. We also have ALEs that sponsor fully insured plans. And then lastly, we have small employers, so they're not ALEs, but they do sponsor a self-insured plan, so they do need to report. Let's take a look at each of these individually. Under ALEs sponsoring self-insured plans, the employer has to issue Forms 1095-C to all full-time employees, regardless of their coverage status. So if they waived, you still have to issue them a Form 1095-C, and that needs to be issued by January 31st of 2016. The employer also must issue Form 1095-C to their non-full-time employees who were covered at any point during the year. So your part-time employees, your COBRA participants, or your retirees potentially. Those individuals must also receive a Form 1095-C by January 31st. Then the employer has an additional month or two to file those forms with a cover transmittal, which is Form 1094-C, with the IRS. If The employer is filing electronically, which is required for employers issuing 250 or more forms. They have until March 31st of 2016 to complete their first filing. Otherwise, that's due February 29th of 2016. The second scenario is ALEs who sponsor fully insured plans. And under that scenario, the employer issues Form 1095-C to all their full-time employees by January 31st, but they only have to complete parts 1 and 2 of the form. The employer files Form 1094-C, the IRS transmittal, with copies of the Form 1095-C with the IRS by February 28th or March 31st. Because the health coverage is insured, the carrier is responsible for reporting what coverage was provided, and they will do that on Forms 1095-B. They must send that to all covered employees by January 31st. And that's the form that employees will use to prove that they had coverage on their income taxes when they file their income taxes. And then the last scenario relates to small employers who sponsor self-insured plans. And under that arrangement, the employer issues Form 1095-B to all covered employees, and then they file 1094-B, the transmittal, with copies of all of those forms with the IRS.
Patty, I wanted to jump in here with an observation and then to answer a question. And one is, you might be wondering why we have small employers that are self-insured, but we're not reflecting small employers that are fully insured. And the reason for that is that in that scenario, the employer does not have a reporting obligation. What will happen in that case is the insurance carrier will issue a 1095-B. So that's why we don't point that out, because you're off the hook on that one. Secondly, question, is this reporting required? Are the employee forms required to be sent to employees who are no longer employed? And the answer is yes. They need to be sent to any individuals who were full-time at any point during the year and or who were covered by a self-funded plan at any point during the year. That's regardless of whether they were employed the whole year or not. It's very similar in principle to the requirement to provide W-2s. You provide a W-2 to an employee even if that person is no longer with the company at the end of the year. So for terminated employees, answer is yes, the reporting and the employee forms are still required. And speaking of forms, Patty, if I'm not mistaken, I think our next slide is to take a look at the forms themselves.
Yes. This is the highlight of the presentation. So this first form that we're showing is the IRS transmittal form. It's referred to as 1094-C. There's nothing really too interesting to point out about this other than if an employer is applying for any type of transition relief. For example, they are an employer that is within 50 to 99 employees and they may or may not be meeting the offer requirement, they can apply for transition relief, and they will do so by indicating accordingly on line 22 of this form. This is the second page of the transmittal, and here is where the employer needs to complete by month their total number of full-time employees versus their total number of employees. For purposes of column B, this is where you need to use one of the two IRS measurement methods that we reviewed for filling out this column. This is page 4 of the form, or page 3, and this only needs to be completed by employers that are part of a control group. And under that scenario, here's where they would list out by name and EIN each separate employer that's part of that group. This is the employee statement, form 1095-C. This is the form that will be issued to each full-time employee as well as each employee that is covered under a self-insured plan. The most difficult part of this form to complete is included in part 2, and that's because there is a series of codes for line 14 and line 16. There's 9 choices for each line that the employer needs to provide a specific and unique indicator code per employee. There will be situations where the same code will be used for multiple employees, but there will also be situations where there will be a unique code for that employee. And so that's where the reporting gets technical, because it's very individual specific. Part 3 is completed for employers that sponsor self-insured coverage. It's important to note that the IRS wants names and Social Security numbers of each individual that's covered, including dependents. And the rules indicate that the reporting entity, including the employer, needs to make at least 3 attempts to obtain a Social Security number prior to defaulting using the dates of birth. This is also an employee statement, Form 1095B. This is the form that will be used by health insurers who offer coverage under a fully insured arrangement. Okay, so I talked briefly about the indicator codes that apply to lines 14 and line 16. Again, this is sort of the heart and soul of the reporting and what makes it difficult. Line 14 is where the employer chooses from 9 separate codes to indicate the type of offer they made or did not made to the employee. And line 16 is where the employer indicates certain safe harbors and other relief that may apply either to the employer or to that particular employee. I'm not gonna go through all of these because it looks kind of scary, but for purposes of line 14, all of these codes will be used by some employer, but probably the most commonly used codes will be 1E, 1G, and 1H. 1E is used to code employees that were offered a plan that provided minimum value, and that plan was also offered to spouses and children. So that will be a very commonly used code. Code 1G will be used for coverage that's offered to non-full-time employees. Joanne asked if you had to issue a Form 1095-C to terminated employees, and you do. And for those months that they are not an employee, you would code them under 1G. And then code 1H will be used for employees that are not offered coverage. You might have a group of ineligible full-time employees. You still need to issue them a Form 1095-C, but you would code them with 1H.
So Pat, I just wanted to jump in here on these codes and ask a question that has come up, and that is, how do I indicate, as an employer, how do I indicate that I made an offer of coverage but it was waived? And the answer is you don't. You don't need to indicate that an employee waived coverage. You just are responsible for demonstrating and certifying that you made an offer. So there's no mechanism to say, I made an offer and this was the type of offer, but the employee waived. You just simply, as an employer, need to meet your obligation to certify that you either offered or didn't offer. So that was just something I wanted, it's come up as a question. I just wanted to jump in with that at this point.
Thank you. Okay, so now moving to line 16 of Form 1095-C. I think I've already touched on several of these, but Joanne, a question came in about waiving, and this sort of ties into that. If an employee waived coverage, you still need to offer them, you still issue a 1094-C on them, but you won't be providing, obviously, any enrollment information in Part 3. For employees that do enroll in coverage, you then need to indicate accordingly on line 16 with code 2C. And then those individuals either will get, if they're covered under self-insured plan, they'll be listed on Part 3, or they'll be issued a 1095-B from their insurance carrier. There will be situations where an employer or an employee, is not eligible for coverage yet, so they haven't been offered, but they may or may not be full-time. And you'll use code D to code them accordingly. For example, if someone's in a waiting period for January, February, March, and then you offer them coverage in April, for the first 3 months of the year, they're coded with 2D so that you're not assessed a penalty on them, and then that code would change to C for the remainder of the year. If you are using the look-back measurement method to determine whether someone is full-time and therefore eligible, for the months that they're in an initial look-back measurement method, they get coded as 2D, which actually refers to non-assessment periods. That way you won't be assessed a penalty on that individual. And then when that initial measurement period is over, then if they're determined to be full-time, that you would make them an offer of coverage and code them accordingly. And then lastly is code 2E, and this will be used for employers that have employees that are covered under a union plan or a plan sponsored by a collective bargaining agreement. There's been this notion that for employees that are not covered under an employer's plan, they don't need to report on them, and that's actually not correct. All full-time employees need to be issued a statement. If that employee is covered under a multi-employer plan and the employer can certify that they made a contribution to that plan, then the employer has met their offer requirement and they would code that individual accordingly with code 2E. So that's I'm not going to spend any more time talking about the codes other than hopefully just to impart that there is, this again is the more technical aspect of reporting, and it needs to be employee specific. I would be remiss if I didn't mention that there are some simplified reporting methods that were available in the final rules. Those are referred to as the qualifying offer method and the 98% offer method. I'm not going to go into detail about how you satisfy or how you qualify to be able to report under those methods, other than to say that in most instances, if these methods really aren't very advantageous, they basically just allow the employer to report less information on the forms, but that doesn't necessarily reduce the time or resources necessary to complete the forms. I'll leave you with, I'm sure you're going to want to be using some outside vendor to help you with this reporting, and make sure in your conversations with your vendor that you approach them with whether or not there is any advantage at all to simplified reporting. There will be some employers that can take advantage of this in a meaningful way, but that's a very small percentage. But certainly reach out to your vendor to see if maybe you might be able to take advantage of one of those methods. And now I'm going to turn it over to Joanne. We've done some research to determine some different vendors that are doing this work in the marketplace. I'm going to have her talk to you about those now.
Thank you, Patty. Well, as Patty said, we have been reaching out to payroll vendors and some what we're referring to as non-payroll vendors. We've gotten some solicitation calls from some of them. So we put together this just high-level overview to give you a general idea of what you could expect. This is by no means an exhaustive list, but we have reached out to some payroll vendors that we know some of our clients use, like ADP, Navigate HCR, Paylocity, Paychecks, and WorksTime, just to mention a few. And then what we call non-payroll vendors. These are entities that in some cases are already doing data collection and reporting in like tax-related areas for employers, and so they've sort of created this niche that they can provide these services for the Affordable Care Act reporting. And some of those are an organization called ACA GPS, there's ACA Track, Assured Partners, and First Capital Consulting. The typical services that we are seeing these vendors able to provide would be things like tracking of full-time employee status, tracking of eligibility, the actual production of the forms, the 1094 and 1095 series, submission of the appropriate forms to the IRS, and in some cases they'll actually provide the employee statements directly to the employees. A question came in just a little bit ago about, will there be a way to upload this information? So can you just press a button and send this to a vendor? And the answer is it depends. There are a few out there who indicate to me that they have that capability. You know, part of the thing is none of us have seen this in action. So I will say that those vendors, one that comes to mind is First Capital Consulting. They tend to be on the higher end of the price spectrum. And speaking of pricing, that's kind of all over the map too, but in general, you could expect to pay, in most cases, a one-time implementation fee. As you can see from the slide, it ranges quite a bit, from $200 for a smaller size group all the way up to $2,500. Generally several of them have a tiered system depending on the number of employees that you have. And then a lot of them, I'd say the majority, have a per employee per month charge, and that, again, wide range between $1 and $5 per employee per month. What we're recommending is that if you do have a payroll vendor that you work with now, that if you haven't already, you have this discussion with them about what they can do to assist you. I think in most cases we need to be pretty clear that this is going to be a lot of data collection from possibly a lot of different sources. I think the idea that to just be able to upload information is going to be, like I said earlier, definitely on the higher cost side of things. So if you don't have a payroll vendor, then we would recommend that you reach out to one of these other entities who have indicated that they can provide this service as well. And we can help you with that. We can help you make introductions. We can help you evaluate and select a vendor. A lot of it depends on who you go with. A lot of it depends on your internal data collection capabilities, you know, how automated you are now, how much time you have to devote to this kind of reporting, because it would be very time consuming, and what your budget is. So this is just, as I said at the beginning, just kind of a high-level overview just to give you an idea of what we're looking at in pricing and an idea of what you could expect as far as services that are available.
Thank you, Joanne. Okay. I was just cruising through questions, and I think Joanne addressed this, but I'm going to reiterate the requirement around electronic reporting, which is required for employers issuing 250 or more forms. The IRS will provide an electronic interface that would allow employers to upload this. That has not, as far as I know, that software has not been released yet, but should be shortly. But I think, you know, I'll leave you with the idea that probably that will be the easier part of this. The challenge in either uploading or even doing these forms by hand is just actually collecting the data necessary to complete the form. We're going to finish up here with just some final reminders and some suggestions for next steps. If you're, again, if you're considering not doing this reporting, please reconsider. It is mandatory. The reporting is provided on a calendar year basis regardless of your plan year. So if you have a plan that runs April 1 through March 31st, you're still going to report on coverage that you provided to the employee from January through December of that year, to the extent that they were covered for that part of the time. Employers must use one of two IRS measurement methods for purposes of this reporting, either the look-back method or the monthly method. And lastly, if this hasn't already become very apparent to you, in all likelihood, the data required to complete this reporting will need to come from multiple sources. You need, obviously, employee specific information. You need payroll information. You need health coverage information. So, you know, in all likelihood, this may involve 3 or 4 separate systems that may or may not all be in-house. And so, you know, there will be, even if you outsource this requirement in full, there's, in all likelihood, would still be work on your part to have to, you know, help complete this reporting. So we leave you with some final suggestions, encouragements. Don't mean to be scaring you about this requirement, but it is a technical one. I would highly encourage you to consider outsourcing some or all of this responsibility. If you don't have a payroll vendor and this is something you want to do in-house, I would quickly start assessing your ability to be able to do that. Start familiarizing yourselves with the forms and, more importantly, the instructions. Those are, if you type in 2014 instructions for forms 1094C and 1095C, you'll get an immediate hit, and you'll want to spend time reading those. But if you don't think this is something you can or want to do in-house, I would, if you have a payroll vendor, first reach out to them, see what they can do to help you. If you don't have a payroll vendor, then there's some other vendors that are out there that can support employers, and MCM is prepared to help you assess, which vendor would be the best choice for you. You'll want to reach out to your MCM account manager to help you with that. We've gotten a question wondering if we will share copies of the slides, and we will be happy to do that when this presentation is over. Bear with me for a second. I'm just kind of reading through the questions. Okay. How does an employer prove that it made an offer of coverage? That's a very good question. So the IRS, for purposes of the IRS, you're going to prove that you made an offer of coverage by issuing a Form 1095-C to the employee and to the IRS. If you didn't make an offer of coverage, that's also how you're going to prove that you didn't. So there's no separate requirement to prove that you offered or didn't offer coverage to the employee. However, we highly encourage employers to have their enrollment and their eligibility procedures in writing, and then that they save their documentation around enrollment so that, if necessary, they can prove that they made an offer, probably more importantly, to the employee versus to the IRS. Deadlines. So those deadlines are rapidly approaching. Reporting is first due in 2016 for coverage that was offered calendar year 2015. Statements are due to employees by January 31st of 2016. And then the IRS transmittal form, as well as copies of Form 1095-C, are due to the IRS either by February 29th or March 31st. And I think we're finished. That concludes our presentation. We don't have any more questions coming in, so I think we will let you off early. Appreciate your time, and for those that have requested it, we will send you a copy of this presentation.
Thanks, everybody. Have a great day.
Have a great day. Bye-bye.